When employees of a workforce need to pay for minor business expenditures such as travel fares, postage expenses, or office supplies expense, how do they pay for them? Rather than having managers approve and formally write out a check for such a small transaction, a petty cash fund is established to reimburse employees for obtaining transactions for work-related expenses. But what is a petty cash fund? A petty cash fund is the amount of cash that is kept on hand and used for paying for small expenditures. As businesses often incur minor expenses, it is appropriate for them to set aside an amount of cash to pay for any costs that are incurred. The first step is to establish the fund. When we establish the fund, the first initial step is to write a check the amount of cash for the fund. After this step is conducted, there is a designated person responsible for the petty cash fund, and this is known as the petty cash custodian. The custodian's responsibilities are to decide on what the petty cash balance is to be, to keep the money separate from the other cash, and to ensure that cash is being used for appropriate transactions. In addition, the custodian is in charge of organising and keeping track of the balance for the given period. Receipts are key for maintaining control over the account and documenting the disbursements made from the fund. To record this transaction, let's suppose that on the 1st of March, a company A cashes a $100 check to establish a petty cash fund. We record this information into a journal entry by debiting the petty cash of $100 and simultaneously crediting cash of $100 to establish the petty cash fund. Second step is making payments from the fund. Payments for expenses can be processed in two ways. Either cash can be taken from the petty cash fund, or employees can seek reimbursements from the fund for payments that they have made personally. As payments are made from petty cash, no journal entries are made. Hence, journal entries are only recorded when the fund is being replenished. However, payments are only to be made for business expenses and must be evidenced by an authorised petty cash voucher with supporting documents to ensure that the repayments were made. It is critical to keep receipts of items that were bought. For example, this can include office supplies, postage expenses, travel expenses, and these can be seen through dockets, receipts, or even tickets as proof of payment. Finally, the last step is replenishing the fund. This is the final stage in the system where petty cash expenditure is refunded, bringing the fund back to the original amount. Once cash is spent, we count the remaining balance and write a check for the replenishment of the fund and then report and journal the entry. For example, assume that our petty cash fund of $100 is currently at a balance of $10. After summarising expense vouchers, we overall have an expense total of $90. After the receipts and vouchers have been approved, a check is recorded at $90, which restores the petty cash fund back to its original amount of $100. However, in a situation where it doesn't balance, this is referred to as cash over and short. Cash over and short can occur when the custodian does not obtain all relevant receipts or full amounts of change from payments of an expense, which overall results in inconsistencies between the amount of cash needed for the replenishment and the amount of receipts. Nevertheless, this amount is often quite small and is included in the petty cash replenishment, which is reported under a temporary expense account called the cash over and short account to identify the amount of cash that is over or under the original amount, causing it to be unbalanced. Overall, the petty cash fund is a vital and helpful financial tool used across various businesses to control and manage small cash outflows that occur in day-to-day business operations.